Welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Blackwell is ramping very fast. 11 billion sales in the quarter. That's well above our expectations. That's well above what the company guided for last quarter of like several billions. And I think that's what the street likes in the print. It means that Hopper revenues are declining overall sequentially. But the most important takeaway here is that it dismisses concerns of a backloaded year.
Well, of course, we're running a deferred revenue model, and so it takes a while for the revenue to build up. And also, the level of scale that we're delivering, Brian, is incredible. We're not a small company. We're now, as you can see, there's only Microsoft and Oracle have ever delivered revenue above 40 billion. So we're in rarefied air. So it will take a while then for Data Cloud and Agentforce to get up there.
The first 6, maybe 9 months of the year will probably end up being in a trading range, and it has been year to date a trading range. But then you'll have a sharp fallback, and particularly your late third, early fourth quarter, typical almost seasonal weakness in the stock market. So it could be just a very wobbly year with a pullback in the market that would benefit defensives because they would hold their value.
1 hour to go until the market close, and we're taking a look at the major averages that are now selling off all across the board. We did get some comments from President Trump sort of reiterating his stance on tariffs and also talking about an additional 10% tariff on China on top of the 10% that had already been put in place. All of that equaling stocks now falling, the Dow off by more than 100 points at the moment. The S&P 500, which was also negative, going further into the red, down 1%, and the NASDAQ down by nearly 2% at this point.
Yeah, there is tough tariff talk. So Trump is saying, okay, those tariffs we talked about on Mexico, Canada, those are proceeding as planned. And then you mentioned this additional 10% levy on China. It's interesting, Joy, because we've talked to a lot of investors on the show and strategists. And granted, they don't work in Washington or inside the Beltway, so they're taking their best guess. We've had many of them kind of emphasize this theme of, well, I think it's a giant negotiating tool at the end of the day, right?
Yes.
And I guess that was sort of the take, and maybe that's the optimistic take.
Well, and that's the take, until you get another headline, which sends things down, and then they come back up again as people think maybe that's the take. So that's kind of the back and forth, the seesaw we've been seeing. But then underlying that, you also have earnings that continue to come in, and we just heard from Salesforce's Mark Benioff there. Investors aren't buying. The stock is down today. If I see it somewhere on this board, I'll point it out, but we know it is lower after the numbers. And then you got NVIDIA, of course, and NVIDIA shares just keep trending lower and lower today, even after its numbers on the whole looked pretty decent, except maybe with the exception of some of the gross margin forecast. But really, the numbers were not that huge of a problem. But maybe if China is going to be more of an issue, that could be a problem.
I think that's part of it. It was interesting because you kind of read through the analyst commentary today of the folks who were actually paid to give you a recommendation on the stock. It was broadly positive, Julie. I mean, it was, results were solid, demand is strong, guidance was fine, right? It was not, though, the kind of blowout quarter that maybe a lot of folks had gotten used to, and that could be playing a role as well.
Yeah, perhaps so. I mean, keep in mind, the last couple of times NVIDIA came out with earnings, the stock did not perform. And then also wanted to look at the sector action here. We've got energy stocks that are still doing well. Oil prices have been higher today. You got tech deeply in the red now. Utilities in the red, being pulled down by numbers from First Energy and Vistra. So those are the two groups that are really creating the big drag today.
Some economic data, too, worth pointing out. Jobless claims jumped above consensus. Pending home sales worse than estimated. All right, President Donald Trump speaking about more tariffs that will be coming during a press conference today. Take a listen to that.
10% tariffs has already been implemented on China. Are you planning to do
an additional 10 above the 10?
This will be an additional 10 above it.
It's 10 plus 10. In
10
case,
plus 10
was there confusion on that?
There was, sir, yeah.
Okay, 10 plus 10, it's a second 10.
For more, we're bringing in now Yahoo Finance's senior columnist, Rick Newman. 10 plus 10, Rick. Make sense of it for us.
20, as many of us would say.
I'm trying to figure if it's compounded or not. I mean, Trump probably hasn't thought this through. He needs to ask his Treasury Secretary, I guess. I think Trump means it. I think he is going to impose another 10% tariff on Chinese imports. As you try to, I mean, it's hard to keep track of all the tariffs Trump has threatened, and then which has he actually imposed so far, and then which ones does he actually mean? I think he means the ones on China because that fulfills kind of a long-term goal he has. I mean, he wants to basically kind of decouple the U.S. and Chinese economies. I think the other ones that would be very problematic for the U.S. economy are the tariffs on Mexican and Canadian imports, 25% each. I think that would be too damaging. So I think Trump is threatening those, because he's trying to get some concession. But Goldman Sachs this week put out a note saying we think markets are underpricing tariff risks because they're being too cavalier about this idea that this is just to get leverage and then they're not going to happen. So we're going to get more of these. I mean, the question, I don't know how many, to what extent we're going to get tariffs, but we're going to get more.
I wonder, what is the overarching goal? In all seriousness, I mean, is it revenue raiser, domestic manufacturing? Is it national security? Does it check all those boxes?
It's not one goal, it's several goals, and this is different from what Trump did during his first presidential term. So what he said then was he mostly focused on the trade deficit, the overall trade deficit with the rest of the world, but also country by country. I mean, he used to say the goal of the China tariffs in 2018 was to lower the U.S. trade deficit with China. He's not really saying that anymore. So among the explanations he has given, help build up domestic industries. I mean, that's just not likely to happen. In some cases, he wants something specific from each country. He wants help stopping inbound migration from Canada and Mexico, even though there really is hardly any inbound migration at this point. Fentanyl, he wants help from these countries with illegal fentanyl shipments. If there's any kind of like positive takeaway, he is structuring these demands in a way that it's easy for him to say, okay, I got what I want at any point in time, because these metrics are fuzzy. He's not saying I want fentanyl shipments audited to decline by 50%. He's just saying I want less fentanyl coming in. So at some point he can turn this around. And we know he's sensitive to markets. So if there's any check on his tariff ambitions, it is markets.
Although it's unclear if we keep saying we know he's sensitive to markets. Is that still the case, though? He hasn't tweeted about it, right? Or truthed about it. I don't know what the verb is there. He hasn't posted about that, really, about how the markets have been doing, even when the markets.
Well, he hasn't had anything to brag about, has he?
No, but it was a little over a week ago that stocks were at a record high.
Yeah.
So he didn't talk about it then. So the thing that we're all taking for granted, that he still cares about markets, I don't know if we should take that for granted.
I don't know that we should either, but here's a clue. We have had the Treasury Secretary, Scott Bessent, saying, we are paying attention to the 10-year Treasury. Right. I mean, that is the most reassuring thing for investors that anybody in the Trump administration has heard so far, because they want the 10-year going lower, and that if in order for that to happen, we have to know that inflation is under control.
Or we have to be worried about growth.
So that's the other side. It could go down.
For it to be going down.
So if it's going down for the wrong reason, which is that the economy's tanking, that's a whole other problem.
Yes.
Thank you, Rick.
Got it?
Thank you. Appreciate it, my friend. For more on the impacts of tariffs on the markets, let's now welcome in Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, it is good to see you. So we were just talking there, Rob, to our colleague Rick Newman about tariffs. President Trump talking very tough there. These tariffs on Mexico and China, Rob. He's saying they're going to proceed as planned. An additional 10% levy on China, Rob. I'm curious, as an investor, as a strategist, you hear all this, Rob. How do you try and make sense of it?
Well, I would say we're following kind of Austin Goolsby's mantra, which is a little bit of wait and see, and how does this impact the data? We were very close to 20+% tariffs on Mexico and China a month ago, and they were delayed at the last minute. I think that's some of what the market is looking at as we think about a range-bound market here, where we're evaluating what are we going to get. If we get them, I think the challenge for us is what does that actually do to economic data? And I know we've had a couple of concerning data points over the last couple of weeks. One would be January retail sales, but that seems explainable by one-off effects. Two would be today's initial jobless claims report, but it is a weekly number. It tends to be highly volatile. That could be a one-off as well. So we're waiting to see if there's a trend that we are damaging consumption in this economy. That has been the primary driver of economic growth if we think about the last year and a half. And that's what we're looking for as we move forward. So tomorrow's personal income data, PCE data will be important. And then the jobs report a week from tomorrow will also be really important. What is the consumer really experiencing? Are they still employed? Can they still spend money? Or are they starting to pull back because of all this uncertainty? And certainly what we've heard from earnings season so far is companies are not clear on the full year of 2025.
They're not clear, and they're worried about tariffs too, Rob. Bloomberg crunched the numbers on the mentions on conference calls of tariffs, and they're at a new record. Something like 700 times they've come up during these quarterly earnings calls. So, you know, it's not just consumers who are paying attention to these headlines. It's obviously companies that are too. So again, I understand the wait and see aspect of all this, but 10% tariffs on China, additional tariffs on China are already in place. 10% then on top of that, it seems, are set to be going into place. And that Canada-Mexico deadline, it's around the corner. So, you know, I understand also the impulse to wait for it to show up in the data, but I mean, everybody's talking about it at the very least.
Yeah, we can't wait too long. And certainly you're seeing some, some technical challenges for the S&P 500 today. I think we'll pay attention to that. For now, we'd still say, you know, it's a glass half full economy, right? We have 4% unemployment, even at 242,000 last week. That's a very low jobless claims number when we look at history. And consumers have been fourth quarter GDP growth was still 2.3%. So we still have a fairly constructive background, and we don't want to miss kind of the next level for the market. I think that the challenge and the risk is one, at what we're seeing today kind of from some of the tech stocks is valuation and any potential hit to growth. But there's other areas of the market that are actually inexpensive and maybe benefit from the Treasury Secretary's preferred lower 10-year Treasury yield. Thinking of income-oriented names, real estate, healthcare, right? There's probably some room for rotation in this market as we look out over the next 6 months. And it's worth thinking about your overall portfolio position and maybe not be too concentrated in those top 8 names and start looking into other sectors of this economy.
Rob, you know, you mentioned earnings. I did want to get your take just on NVIDIA. We were waiting on pins and needles, Rob, for that report, right? It was going to be the most important report of the earnings season. We were all going to hang on, every word of CEO Jensen Huang on the call. And clearly investors seem disappointed today, Rob, in that report. I'm just curious, that report, the reaction, the response to it, are there broader lessons for the market as a whole, Rob, that you take from that?
Well, I think the challenging thing about this earnings season, and we've seen it in the economic data too, is it's been kind of in line as expected, nothing exciting, right? Nothing to tell us things are going horribly, but nothing for us to get tremendously excited about at this point either, which is kind of why we're seeing this range-bound market. And I think that's what we're hearing from NVIDIA. They delivered, right? They delivered on expectations. They slightly improved on forward views. And we've heard that from many companies so far. No one's been tremendously missing. Not no one, but right on average, right, we're coming in line with where we expected, and we're not getting a lot of forward guidance. And I think that's really the challenge for the market is with that lack of clarity, we're waiting for a driver or something to give us direction. And that's leading us back to the Fed, maybe tariffs, but we're not sure how much and how long. And then economic data.
So as you wait, right, you said you're looking to some of those areas of the market, like healthcare, for example. Healthcare that trade's gotten a little more crowded this year, right? It's actually the best performing S&P 500 group this year so far. So kind of what characteristics, I guess, are you looking for, either within healthcare or more broadly in the market, that you're looking to ride this period out with?
Yeah, we think it's companies that are sensitive to interest rates in a kind of constructive way. So as we get interest rates staying lower, right, the Fed's bias is eventually, maybe someday, to cut rates again in 2025. we think those are the sectors that start to do better. We've seen decent performance from real estate. We could see decent performance from utilities, particularly as they start to incorporate some of the past price increases into their earnings moving forward. And then healthcare really broadly rather than narrowly for us, because this is a sector that's been really challenged, and things probably are not as bad as we've seen prices take the hit over the last couple of years, and things could get much better there.
What about technology and communication services, Rob? Would you stick with those sectors?
We think you have to be there in the long run, right? There's some real risk here at the top. For us, that's a long run hold. We think it's constructive over time, but certainly as we're seeing today, right, there's some near-term challenges, and these are already very heavy weights in portfolios. So rebalancing remains an important thing for investors to think through how much. You're already kind of over allocated in those spaces. It's worth looking to other elements of the economy that could see benefits as we press ahead, not just technology.
Rob, thanks so much. Good to see you.
Thank you. Very good to see you.
Kansas City Fed President Jeff Schmid speaking earlier today, giving his thoughts about the path for inflation. He had a unique approach amongst Fed members. Yahoo Finance's Jennifer Schonberger has the details for us. Hi, Jen.
Good afternoon, Julie. Kansas City Fed President Jeffrey Schmid says he's growing more cautious that inflation can continue to drop as consumer expectations for inflation have surged. In a speech this morning in Arlington, Virginia, Schmid said, quote, "Now is not the time to let down our guard. It could be argued that some of the factors driving up inflation expectations are likely one-off transitory developments. But again, given recent experience, I'm not willing to take any chances." Schmid's concerns come after a survey from the Conference Board showed consumer confidence dropped sharply this month as inflation expectations for the year ahead jumped to 6% from 5.2% amid higher egg prices and concerns about tariffs from the new Trump administration. Schmid said that while the risks to inflation appear to be to the upside, discussions with contacts in his district, as well as some recent data that suggests that uncertainty might weigh on growth. Indeed, if you take a look at a chart of the 10-year Treasury, the yield appears to reflect that sentiment. The yield today as low as 4.26% on the session, having steadily dropped since hitting nearly 4.8% in mid-January. Schmid following many other Fed officials in recent weeks to take a wait-and-see approach, though the threat uncertainty poses for growth is one Schmid says the Fed will have to balance with upside risks to inflation, and we will get a fresh reading on the Fed's preferred inflation gauge tomorrow. Back to you.
Can't wait, Jen. Thank you. We're just getting started here on Market Domination. Coming up, Synopsys reporting a beat on its latest earnings results. We'll hear from the company's president and CEO on the other side to discuss those results. Stick around, much more Market Domination still to come. Synopsys delivering a beat on earnings and reiterating its full-year guidance, including expectations for double-digit revenue growth. The company noting it continues to see strong design activity fueled by the AI-driven reinvention of compute. For more on the quarter and what's ahead for the company, we've got Synopsys CEO and President Sassine Ghazi. Sassine, it is good to see you as always here, and it's especially interesting to talk to you on a day, of course, NVIDIA, one of your big customers, reported last night. Those shares are down. And it doesn't seem like there is uneasiness about the AI thesis, but maybe just about sort of the growth trajectory and what's priced into the stock. So I'd actually would start there, how you're sort of thinking about where we are in the cycle and what investors should be expecting from here.
Hi, Julie. Great to be here. Like any disruptive technology, and AI is absolutely one of the mega trends that will drive a completely different change in many end market applications workflows. It started with big investments in data centers and infrastructure build-out. Now what we're seeing is that early adoption of AI applications at the endpoints, be it your PC, your mobile device, etc. And DeepSeek actually was one of the great proof points that as you make it cheaper, more reliable, more affordable, you get adoptions at the application level. And that drives silicon proliferation everywhere because you need silicon both at the training and data center and silicon at the end device level, which is a great opportunity for Synopsys.
Sassine, on the conference call, I want to come here to a line you said. You're talking about your end markets, Sassine. You said from an end market perspective, AI and HPC remained robust in the first quarter. Then you said, Sassine, while industrial, automotive, and consumer electronics remained challenged. So I guess if I was an investor, Sassine, I'd want to know, where is the bottom there? Do you have line of sight?
Yes, on AI, HPC, very strong silicon design activities with actually a pace that is shrinking, meaning the roadmap is being accelerated from 18 months to 1 year delivery on these products. For consumer electronics, mobile and PC, in the last 2 quarters, we saw a pickup on new silicon design activities to bring AI to these devices. And you see it happening with number of customers and number of applications. The place where we have not seen customers bringing new roadmap items is in automotive and industrial, which is expected to happen toward the end of 2025.
I want to ask you about China as well, because I know you're experiencing some headwinds there, like many in the industry, and there's uncertainty about whether further export controls will be put into place, right? We just heard President Trump today talking about another 10% tariffs on top of the 10% tariffs that have already been imposed, and we could get retaliatory tariffs. So how are you planning out for all of those possibilities?
So China for Synopsys, if you look back 5 years ago, was growing well above the corporate average. In Q4 23, we started communicating that is going to decelerate to around corporate average, which happened in 2024. What we communicated actually yesterday as we are reaffirming the guidance for the year is these headwinds are going to continue and the deceleration will continue to below corporate average due to 2 factors. The first factor are the restrictions. The cumulative effect of these restrictions are slowing down the chip activities, especially for the high-end chips in China. And the second one is the macro and the economy inside China remains challenging. And when you bring these 2 factors in, that's the cautious that we provided around China.
Sassine, do you think that these export controls are the right policy for the U.S.? You know, obviously they're disadvantaging companies like yours and many more, and you still had the development of something like DeepSync. Do you think these policies are misguided?
You know, we work with the U.S. government, actually with the Biden administration, now with the Trump administration, to promote a resilient supply chain for the exact reasons that you just mentioned. The restrictions are having an impact where it is slowing down an organic development inside China. But if you zoom out to the macro, like the DeepSeek example you mentioned, it really demonstrates the ingenuity of engineering. When you over-constrain a problem, you try to find a different way to optimize. And what they've done, they optimize at the software level, distilling the model from a training in order to get to an end application. So there's always a way to look at the overall optimization chain and find an opportunity to optimize.
Sassine, is this deal for Ansys, are you still confident it's going to get done in the first half? First half, Sassine, June is going to be here before we know it. And how confident are you the Chinese are going to really approve this deal? I was talking to an analyst today, Sassine, he covers your stock, covers the name, and he argues this is an overhang on the stock.
It is an overhang on the stock, but we continue to anticipate a closure in the first half of 25. And really for 2 reasons. China will be no different than other jurisdictions, that this is one, a pro-competitive deal, and 2, significant support by customers. And as you see how we have navigated through the approval process with FTC, CMA, EC is based on these 2 components and theses. And we don't believe it will be different or should be different with SAMR in China.
Sassine, it's really good to see you. Thanks so much for joining us.
Good to see you too.
Now, Now time for some of today's trending tickers, starting with IonQ. Those shares down double digits today after the company reported fourth quarter earnings that included a loss per share of 93 cents. That's far worse than what the street was estimating. The quantum computing firm did report a revenue beat, however, but it looks like that, that investors were kind of viewing it, analysts at least, kind of viewed it as a mixed report.
Yeah, and I mean, stock down today, but pull back that chart. I mean, it's been a huge move at 125% over the past 12 months. Some changes in the C-suite too. CEO change. They named Niccolo De Masi as the CEO. Analysts do broadly like this name, even after this run. Needham is one of them, has a buy in it. Told their clients, solidifying itself, they say, Julie, as the 800-pound gorilla. Right. In quantum networking.
I mean, something to point out here when we're talking about any of these quantum computing companies, I mean, the company for the full year is looking for revenue of at most $95 million. They are not large yet, right? This is still very early stage. And so it's not that the earnings are irrelevant, but this is mostly just a bet on the future of quantum computing sort of more broadly.
Vision.
Exactly.
Yes.
On the vision.
Our next trending ticker, let's check out C3 AI, the enterprise AI company delivering a Q3 beat on both earnings and revenue, but it's down today after reported revenue growth below the gains it posted in the previous quarter. So AI software company posting results. Obviously, folks seem a bit underwhelmed here. Analysts at Bloomberg, by the way, saying report signals little movement and share gain from growing enterprise AI investment or its multi-solutions foray, while its recent partnerships with hyperscalers, though a step in the right direction, they say, likely leaves the pace of revenue uplift unclear.
Yeah, and because the pace of revenue uplift is unclear, the pace of when they're going to turn profitable is unclear. According to Morgan Stanley, they're asking about the timeline for operating profitability, for them to tick into profitability, and for positive free cash flow as well, and sort of drawing that into question because the revenue growth is sort of decelerating to some extent.
Yeah, Oppenheimer, they have an outperform on this one. Again, they mentioned the strategic partnerships they mentioned companies like Microsoft. They say positions this one for accelerating growth, though it does look like they did lower estimates on the company.
Yeah. And then we got Mara Holdings, our next trending ticker, the company formerly known as Marathon Digital, getting a boost today after the crypto mining company reported record high revenues and net income for the fourth quarter and the full year. The company also revealed it reduced its energy costs significantly by deploying its first owned power generating assets, and it said it was exploring opportunities in artificial intelligence. Who among us is not doing that?
Right. Total revenue for the fourth quarter, that beat came in around $214.4 million. Needham has a hold on this one. They say potential revenue diversification positively as the Bitcoin backdrop is becoming more uncertain. It's been rough though. Look at this chart. It's down now about 55% over the past 12 months.
Well, they trade a lot with Bitcoin, and they are among the companies that have Bitcoin on the balance sheet. So that's something
you're saying can get volatile
as well. Can be.
Yeah.
Yes.
All right, coming up, we're going to hear from the Port of Long Beach CEO on the other side to break down what the impact of Trump's tariffs could mean for ports. Stick around, much more market domination still to come.
The Port of Long Beach just had its best January ever, and it was also the second busiest month in its 113-year history. But with President Trump's promise of tariffs looming, officials are preparing for a new world when it comes to cargo volume and labor demand. Joining us now, Mario Cordero, Port of Long Beach CEO. And Mario, to be clear here, you guys had this amazing month, but that's because people are trying to get ahead of the tariffs, correct?
Well, there's a component of that people are front-loading imports to get ahead of the tariffs. But on the other hand, it also is reflective of the economy that we have here in the U.S. We have a very good economy thus far, and consumer spending in the holiday season from November to December. I mean, those numbers increased beyond the expectations that some economists had previously.
So Mario, President Trump talking tough on tariffs. He loves tariffs, Mario. We know that. I have a couple questions for you on that. If they are ratcheted up, Mario, how does that impact you all? How does that impact import volumes? And two, Mario, if they're ratcheted up, who bears the cost of that? Is it the shippers, Mario, or is it Mario and Josh?
Well, thank you for the question. As to the first part of the question, I can answer that just by looking at the previous impact when we first encumbered the tariff issue, and I'm talking the first Trump administration. So if you look at the initial tariff implementation back in 2018, the Port of Long Beach, when you look at our 2019 volume as compared year to year to the previous year, as a result of that tariff policy then, that continues, we lost about 20.5% of imports coming from China. So that was the impact then. And of course, now it remains to be seen what that impact will be moving forward.
Well, what kind of indicators are you getting, right? Because the 10% additional tariff on China has gone into effect. There might be another 10% on top of it, according to what the president talked about today. So have you started to see any kind of change in flows?
Well, we have not started to see any change. Obviously, we commenced the commentary this morning or this afternoon with the record year that we had in 2024, and that's furthered by our numbers that we've had in January. So far, again, we're having record numbers. But on the other hand, there's also concern that you're seeing, whether it's from the Conference Board, the University of Michigan Consumer Confidence Survey, and of course, economists across the board with regard to potentially what that impact may be.
Most of the stuff coming into your port, Mario, it's coming from where? Would that be China?
Primarily, our imports are from China. So if we go back to the 2019 experience, as I mentioned, we had a 20% reduction in imports from China back in 2019 as a result of that first implementation of tariffs. On the other hand, we did have a 10% increase from other regions, from Southeast Asia specifically, countries like Vietnam.
I also noticed there was a headline about a proposal. It hasn't been approved yet, but a proposal from the U.S. Trade Representative that would charge a fee on Chinese ships who are coming into U.S. ports, whether it be Long Beach or any of the other ports around the country. The fee could be up to $1.5 million per ship. If that went into effect, what would that do to your business? What would that do to prices of goods that were coming in on those ships?
Well, first of all, that would impact all U.S. ports that have imports coming into the country. And by that, I mean every major international carrier either has vessels that are built in China or has vessels that are built in China as part of their fleet. So one way or the other, it is going to have an impact with regard to the fees that will be now accompanied with a vessel call to any port in the country, be it Long Beach or the Gulf or East Coast ports.
Have you all, Mario, been talking to the Trump administration?
We haven't had any specific conversation, although I do know that our industry advocacy groups apparently have had that concern. And again, those concerns are being expressed. On the other hand, I will say that if in fact some of this tariff discussion is being put forward in the aim to negotiate other aspects that the White House believes are legitimate to address, then again, I think we have to have a wait and see scenario. So at this point, I think if we have a conversation 6 months from now, we'll be in a better position to assess what those impacts are.
Mario, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thank you so much for the invitation.
Earlier today, President Trump announced that his proposed tariffs on Mexico and Canada will go into effect on March 4th and clarified his plans for additional tariffs against China. Take a look.
10% tariffs has already been implemented on China. Are you planning to do an
additional 10 above the 10?
This will be an additional 10 above.
It's 10 plus 10. In
10
case,
plus 10
was there confusion on that?
There was, sir, yeah.
Okay, 10 plus 10, it's a second 10.
The president has made tariffs a core piece of his second-term agenda, touting them as a revenue source and wielding them as a threat against other countries. Joining us now to discuss all this is Edward Fishman, Senior Research Scholar, Center of Global Energy Policy at Columbia University, and author of Choke Points, American Power in the Age of Economic Warfare. Ed, great to see you here, and congrats on the book.
Thanks so much. I'm so happy to be here today.
So you're actually the perfect guy to talk to today. Well, listen, President Trump talking tough on tariffs. He likes tariffs. He likes sanctions, Ed. Tariffs as a policy tool, I'm curious, as you look throughout history, traditionally, typically, how effective are they?
So tariffs throughout history have really been used more as an economic tool, either to raise revenue, as you mentioned before, sometimes to protect industries domestically from foreign competition. The thing that's a little different about how President Trump is proposing to use tariffs, he's trying to use them as a tool of economic warfare, to pressure the Canadians and Mexicans to stop the flow of fentanyl across the US border, to pressure China from stopping to send fentanyl to the United States. So he's really using tariffs as kind of another form of sanction, as something that he could use to get America what it wants.
So given that that's not traditionally how they've been used, what can we extrapolate from history about how effective they might be?
Look, tariffs, generally speaking, if you're using them as a tool of economic warfare, are a very weak tool. So you think about what is a tariff? A tariff is a tax on imports. So even if Trump does put a 25% tariff on Canada, US companies will still be able to import things from Canada. They'll just pay a 25% tax. That's why tariffs, generally speaking, are not good for US companies. By contrast, sanctions block everything, right? So if you impose a sanction, for instance, on a country like Iran, we can't import anything from Iran, right? It's a much more aggressive instrument.
Well, and it's seen as a much more. I mean, if it's dramatic enough that the president is threatening these tariffs against our allies. But if he was to say, "I'm going to put sanctions on Canada," I mean, maybe that would be a line he couldn't cross. I don't know.
I mean, it's not something I would recommend.
Right.
I think tariffs on Canada and Mexico are also not a particularly wise policy. And we'll see if they actually happen. I think when President Trump was gearing up to do this in early February, Monday opened, the markets were not very happy about the prospect of 25% tariffs on our two biggest trading partners, and Trump backtracked. So my strong suspicion is I don't think these tariffs are going to go into effect next week, at least on Canada and Mexico. Will we see an additional 10% tariff on China? May well. And that's actually a big point of what I talk about in Choke Points, which talks about how Trump developed his China policy. And this has been a consistent theme: tariffs on China, export controls on Chinese tech companies like Huawei. But we haven't yet seen anything like that against Canada and Mexico.
And the title of your book, Edward, is Choke Points. What are choke points as governments define them?
So historically, choke points have been geographic features, like the Bosphorus, which connects the Black Sea to the Mediterranean. And historically, the only way to really block a choke point was to literally take a Navy ship and park it right in front of it, right? And that's a big part of how warfare happened all the way up through the beginning of the 21st century. What's happened is, in the wake of hyperglobalization, with deeply integrated financial markets and supply chains, now a US official can just sign a document in his or her office in Washington and block these choke points across the world. And so what we're using now aren't so much these geographic choke points, they're economic choke points, like the US dollar, like advanced computer chip technology, and like energy supply chains, in which the US has a dominant position and there are very few substitutes.
And so how is this remake? We've talked a lot about the remaking of the global order over the past, call it decade, right? Where you're not as much seeing this coming together of global economies, but more of a re-separation of those global economies. What then is the outcome of all of these leaning on these choke points?
This is the narrative that I talk about in my book, Choke Points. Globalization is dead. And we are now living in an age of economic warfare. Sanctions, tariffs, export controls, they are the primary way that big powers like the United States, like China, like Russia compete with one another. And this has been a trend now starting in 2005, 2006, that's just grown exponentially and is going to continue to grow exponentially during Trump's term. So I think where we're headed is really one of two futures. One, where we have still tight financial and economic linkages, but only with other allies, only with other democracies. And where there's another bloc that's led by China, very similar to what it looked like during the Cold War with the sort of West and the Soviet Union. But there's another future, and this is the one I'm actually more worried about. And I think it's where, if Trump were to go ahead with tariffs on Canada and Mexico, it's where it would take us. And that's a more chaotic breakdown of the global economy, in which every nation is sort of for themselves, and companies in the US can't feel confident about long-term investments unless they're in the United States. And where the reason that's bad is not only will it be bad for the United States economically, inflation, slower economic growth, but history shows that when states can't acquire markets and resources through open trade, they're tempted into things like imperialism and conquest and war.
I'm curious, you mentioned a number of choke points that government officials can potentially have at their disposal. Is there one choke point that you would say that typically is the most impactful one?
The US dollar is by far the most important choke point. If you look at it, 90%.
That seems pretty good for the US.
It is. It's why we're the most powerful country in economic warfare. 90% of all foreign exchange transactions include the dollar. So if you're doing trade internationally, you're using the dollar. The thing is, though, there are choke points come and go, and some of the most important emerging choke points are actually under China's control. A key one is critical minerals. And I think if you're looking at the deal that Trump is trying to strike with Volodymyr Zelensky when he's coming to the White House tomorrow, a lot of that is to try to reduce China's ability to weaponize this choke point against the United States.
So I guess my question would be, we know that President Trump views these negotiations as having a winner and a loser, right? We know that from historically how he has operated. With the U.S. still having that powerful U.S. dollar as the most important choke point, will the U.S. win?
Look, I think so far what Trump has been threatening has been tariffs. Tariffs are not weaponizing the dollar as a choke point. They're weaponizing the American consumer, right? The fact that we're a big importer, right? Because remember, tariffs are a tax on imports. Were Trump to go ahead and threaten financial sanctions against Chinese banks, that would be a much more significant threat to be putting on China than tariffs.
Eddie, thank you so much. Really interesting stuff.
Yeah, my pleasure. Great to be here today.
Coming in. Well, the Personal Consumption Expenditures, or PCE price index, it's a measure of inflation that tracks how much prices change for goods and services. Kenny Polcari, host of the Yahoo Finance podcast Trader Talk, takes a deeper dive at what the index measures and how it can be viewed as more important than the Consumer Price Index.
What is the PCE index? The Personal Consumption Expenditures Index is a measure of inflation that tracks changes in the prices of goods and services purchased by U.S. households. It is released monthly by the Bureau of Economic Analysis and is considered a more comprehensive and accurate reflection of inflation versus the Consumer Price Index, or the CPI. The PCE is derived from consumer spending data and includes adjustment for shifts in buying behavior, making it a more dynamic measure of inflation. It is often compared to the CPI, but the Fed prefers PCE for monetary policy decisions. What does the PCE index measure? Well, it measures price changes in goods, so think food, clothing, cars, electronics, services, healthcare, rent, education, financial services, durable goods, appliances, and like I said, automobiles, non-durable goods, gasoline, and grocery products. Headline PCE includes all categories, including food and energy. Core PCE excludes food and energy, which are typically more volatile, and, like I said, is the Fed's preferred measure of underlying inflation. Why is this important? Well, because it is their primary gauge. It is the Fed's primary gauge. The Fed uses core PCE, not the CPI, when making interest rate decisions, and that's important. The Fed targets 2% inflation year over year based on the core PCE. Today, the core PCE is plus 2.8%, so we're close but not there yet. If PC inflation is high, the Fed is more likely to raise interest rates because that would suggest a hot economy, so they'd raise it to cool the economy. If PC inflation is low, that may suggest the economy is struggling, so they would cut rates to stimulate growth. It is more accurate than the CPI. The PCE is considered more reliable than the CPI because it captures a broader range of goods and services. So, for instance, healthcare spending paid by employers. Right? It accounts for consumer substitutions. So, for instance, if steak prices rise, people may buy chicken instead. It's less volatile than the CPI, providing a smoother trend line for policymakers to consider. The bottom line? Why should investors watch the PCE? Because it determines the Fed's policy. The Fed bases rate hikes or cuts on the core PCE trends. It moves markets. A hotter PCE reading can cause stocks to sell off, while a cooler PCE reading can spark a rally in stocks. It reveals economic strength or weakness. Rising PCE suggests strong demand, while a falling PCE may suggest consumer slowing spending. Here's the final thought. If you're trying to predict the Fed moves and understand interest rates, then watching core PCE is non-negotiable. It's the inflation number that actually matters.
Wall Street still digesting yesterday's earnings report from NVIDIA. One segment that stood out was the company's automotive business. For more, we're bringing in Yahoo Finance senior autos reporter Pras Subramanian. I mean, we talk all about the data center business, right, Pras? That gets a lot of attention. But the auto segment is growing quickly.
Yeah, we talk about that juggernaut Blackwell chip business, but under the radar here is that auto business, up 27% from the prior quarter and up over 100% year over year. NVIDIA's CFO said the bills will grow from 1.7 billion to 5 billion this year. So it's not nothing, but basically the way it works is that when it comes to self-driving, there's tons of data that's collected. It needs to be analyzed. This is where AI comes in and NVIDIA's chips powering it. Jensen Huang said Jensen Huang and others believe there'll be millions upon millions of self-driving cars out there and tech out there. I believe that is true as well. It's called physical AI or embodied AI. It's autonomous cars, even robots, harnessing the power of AI to move freely in the real world. That's sort of the big bet here on NVIDIA with cars in particular.
And I want to ask you also about cars moving around in the world without drivers, right? There's a report today that Tesla is exploring doing some trial runs in California of its cyber taxi. This according to the Washington Post. This may be not a surprise because we knew that they're going to be testing this, but what do we know so far?
It seems the Washington Post got a hold of Tesla's application for a permit to test these cars, and basically it'll allow users to summon Tesla vehicles for free for now on robotaxi trips. The permit states that Tesla will own and operate the vehicles and that employees are there to observe, so they'll be in the cars when the cars are being deployed. This is in contrast to Texas, where the company will test paid unsupervised robotaxi drives, similar to what you see with Waymo in different cities in the States. This is huge for Tesla, right? So it's the big bet on its valuation hinges on the success of robotaxis and fully autonomous vehicles. Same could be said a little bit for NVIDIA and its auto business too, but one thing is for sure, we have a long way to go before this is actually reality for many of us here.
Praz, great to see you. Thank you.
Thanks, man.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.